Joining me today on Brief Encounters is Dan Glazer, the founding partner of Wilson Sonsini's London office. He spent over a decade helping UK and European startups scale into the US, advising on everything from fundraising to expansion and navigating not just legal, but business strategy across the Atlantic. We're delighted to have him. Welcome to Brief Encounters, Dan.
Thanks a lot, Richard. Really happy to be here.
So to kick us off, Dan, you've spent a ton of time on both sides of the Atlantic now. What made you get into this kind of work, and what prompted the move to London, and kind of how have you found this sort of very powerful wedge, which you have been so helpful in driving forward in the UK?
So it actually harkens back to the late 1900s when after I graduated uni or college for your American listeners back in the US, and I went off on a backpacking trip between college and law school for a couple of months, and went all around Europe with a Eurail pass and Brit Rail pass. And I got to London, ended up staying for 3 weeks, and said, I got to find a way to live and work here at some point. And sort of kept that idea burning right in the back of my mind for about 15 years. And then finally, after the Cameron government launched the Tech City Initiative in 2010, so I took a meeting in New York in 2011 at the British consulate, right, with the Department for Business and Trade team. And I'm an expat New Yorker now in London. Although any of your listeners who might be in New York, I have to give up the ghost. I'm from New Jersey. But I'm more or less an expat New Yorker, and was always working in Manhattan over the years. And took a meeting with the UK government in New York. And they said, listen, historically, we had seen American tech companies come to the UK, but now with this new Tech City initiative, we expect that we're going to see a lot more UK tech companies come to the US. How do we help them? And if you can do it on the ground in London, that would be brilliant. So challenge accepted, as they say. And I started, spending more time coming across to the UK, and actually literally split my time between the UK and the US to build up the business case for building up an American team on the ground in London. Formally opened the office in the summer of 2018. And today we are running a blended, integrated American and British team on the ground in London that works with UK and European startups through that US life cycle, Richard, as you mentioned earlier.
I remember when we started working together, Dan, and we were just raising a Series A, and we had a US investor, a Union Square Ventures, come in. And I remember having a chat with you, and you were explaining to me that there are some fundamental differences between the US venture capitalists and between the UK and European venture capitalists. Culturally, what are the kind of key differences that tech companies should be thinking about when it comes to actually expanding to the US? Because I know there's a whole bunch of legal stuff, but there's also kind of cultural and other really interesting things, right?
So let's talk about fundraising for a second. What are the differences between VC investors that you might see in the US versus the UK and Europe? And I think the most important point to start with on that, because this is a common question that I get, is to keep in mind that UK, and I'll focus on the UK for purposes of this discussion, UK venture capital is not homogenous, right? And when we talk about UK VCs, what exactly are we actually talking about there? And the way that I think of it now, and this is a little bit of an oversimplification, but I think it's directionally true, is that if you think about the venture capital ecosystem in London in particular, you've basically got 4 different types of venture capital, broadly speaking. You've got literally the American funds in London, right? And I think that there's about 50 or 60 of them now that have offices in the UK and Europe, and most of those funds have offices in London, the ones that are in the UK or Europe. And the American funds, especially the sort of classic Silicon Valley or Silicon Valley style funds that have offices here, the way that US funds like that think is sort of, for every 10 investments, 7 may fail, 2 are going to wash their face, and 1's going to return the fund or more, right? I mean, it's classic power law stuff. And they will place their bets accordingly. And they're willing to take pretty massive risks, relatively speaking, in order for, relatively massive potential upside. That's That's sort of the first type of venture that might be available in London. And then the sort of next stage, and I'm thinking of it as sort of like a spectrum of risk taking, right? So that's sort of the one end of the spectrum. And the next area in the spectrum, I would say, are the sort of American style funds in London. And those are the ones that have a similar sort of ethos, that they are looking for companies that can return the fund or more, right? And will readily walk away from companies that might be able to show a more certain but smaller exit for the opportunity to invest in a company that might have a possibility but maybe less certain bigger exit, right? But again, those are not the American funds, but they're UK or European funds that have a similar approach and a similar appetite for risk. The third category on that risk spectrum, I would say, would be, let's call it the VCT, EIS, and SEIS funds, right? The funds that are interested in finding companies with substantial upside, but are also investing on the basis of potential tax benefits, right? And so maybe they don't need the massive shoot for the moon, and we might fail and crash and burn, right? Because there is a benefit there's an economic financial benefit that they're getting that's not simply based on the performance of the company. There are those VCT and EIS and SEIS benefits, right? And some of those funds are fairly risk taking, and it's on the spectrum even within VCT, EIS. And other funds within that group are maybe are a little bit less risk taking and looking to maybe manage downside risk, and are willing to sacrifice potential upside potential in that context. And then on the fourth is sort of British private equity, right, which is dropping down and doing venture stage investments, but perhaps through a private equity lens, which is very clearly reducing the level of risk being taken in any particular investment in exchange for a reduction in the upside potential, right? Reducing downside risk, but reducing potential upside. And I think what gets confusing for companies in the UK and I'll extend it more broadly into Europe is that it's all called, broadly speaking, venture capital, right? But the approach of one end of the spectrum, the American, especially the Silicon Valley funds, is very different from the approach of, let's say, a British private equity fund that's dropping down and making venture stage investments. It may all be called venture capital on this side of the Atlantic, but it's not in the American sense, right? Whereas, especially at the earlier stages, you go out and raise a seed or a Series A, right, in the United States, especially from the Bay Area, it's a lot more homogenous, right? The assumption is going to be, for the most part, that the funds there are looking for founders who are looking to go on that shoot the moon journey, right? Where, there's a very good chance that they're going to fail, but if they hit it, they're going to hit it massively.
And return the fund 10, 100 times, right?
Return the fund. And the most important thing that I stress to companies on this side of the Atlantic is that you really got to find the right fuel for the engine, right? And to belabor the obvious, the fuel being the money, the engine being the company, if the management team of the company is convinced that it wants to go on that multi-unicorn journey and is willing to take the risk that comes with that, and frankly, the responsibility that comes with that, to take, 25, 50, 100 million from US investors, and put that to work to potentially create a multi-unicorn, if they want to go on that journey, well, then recognize that if they bring in, kind of a British private equity fund, like, there's going to be real friction at the board, right? As to what we're doing here. Like, are we going for short-term profitability, or are we going to, burn cash as quickly as possible to win the market and then flip to profitability at scale? But on the other hand, if the management team is thinking, actually, I wouldn't mind building this to a long-term sustainable profitable business, get to break even as soon as possible, run it for 7 to 10 years and sell for like 50 to 75 million. Look, that's great. Like, that's an amazing outcome. That is not the outcome that they're looking for on Sand Hill Road in Silicon Valley, right? And so that's what I mean about putting the right fuel into the engine. I think too often, not enough companies have asked the VCs, and the VCs have not asked their companies if their interests are actually aligned as to what they're both trying to do here.
Right. And it's so fascinating seeing it from a founder perspective as well, is there's just so many traps you can fall into, right? So I remember, having a potential angel investment thrown at me, and one of the slides was, here's our exit plan. And this is kind of a pre-seed round, all of a sudden in a bucket of maybe someone wanting to build a business with maybe one round and it's going to kind of get to like a 10 million exit and people are going to make money. But to present that to like a Sandhill Road VC, it would be a kind of a suicide mission, right? Because 10 million is lost all their money. And it definitely definitely that market education, certainly for me, it took quite a bit of time actually to go and get up that curve. That's really fascinating.
I have a lot of sympathy, frankly, for management teams on this side of the Atlantic who, maybe they have been talking to funds that are in sort of like category 3 and category 4 of that spectrum that I was laying out, where the investors are, want to see a good return, but they're not necessarily comfortable with that massive risk of, hey, we might throw millions and millions at this and the thing crashes and burns, right? And then you go out to the United States. I'll tell you, like, I've had discussions with US VCs who like will see trade missions of UK companies come into New York or Boston or Silicon Valley, and they'll do their whole pitch. And the VC will say to me offline, like, why are they all focusing on telling us how close they are to break even? And I have to explain, I'm like, because that's sometimes, and maybe even oftentimes, how you end up raising money in the UK is by de-risking the investment, right? And they're like, and the US VC is like, this doesn't compute, right? Like,
I mean, we did this trade mission last week in New York, right? So it's topical for us. And I remember one of the slides that was shown to us, really interesting, was a map of the states of the US. And it was the one that you've probably seen it multiple times, where they basically take California, for example, and replace the name California with the United Kingdom. And it basically shows a comparable GDP. And I think it was, the UAE was Wisconsin. There was something like this. And so this sobering thing, if you're suddenly entering this enormous market of incredible scale, and the question to all of us kind of UK founders is, how do you crack it, and how do you work it? And we just did this survey, the State of In-House report, where we had 160 lawyers. We asked them this question on like, where's the best place to start? And factor of I think 2 to 1, they said the US. And so the thing that I'm always curious about is that right? Or actually, as kind of UK headquartered businesses with US presence, like, should we be backing ourselves more here?
Our experience is that there are 2 particular points where it makes a lot of sense to go aggressively after the US, but getting the timing right is everything, right? The first point is to potentially go early, right? Is that as a company, as a founding team, as a management team, you decide pretty early in the company's life cycle that, the product or service offering that we are creating here is really going to land best in the United States, that the market we really want to nail is the US. So why don't we optimize for the American market at the beginning, right? And the kind of money that we want to raise to build that product or service offering and scale, and the kind of help that we need from VC investors, we want to get in America. So great. So what you'll do is you'll move part or all of the management team to the US, and then keep, let's say, certain back office functions in the UK as a US front facing transatlantic business. You're probably going to raise your rounds from US investors because you've got the management team there, and you will look and feel like a homegrown American business, because in a lot of ways you are a homegrown American business, right? That's going early, and that is a potentially successful strategy. I mean, look, you may fail because like you don't get product market fit in the same way you might fail in the UK for not getting product market fit, but in principle, right, you can absolutely crack the US in that way. The other companies that are successful, and this is much more common, I would say, in 2025 relative to like when I started talking to British startups about this in like 2011, 2012, 2013, is to go late, right? Is to nail the product market fit here in the UK and raise, let's say, your pre-seed, maybe your seed here in the UK. But then what often happens is, and there are different points in a company's life cycle when this may happen, but I would say most often it happens between somewhere like late seed and let's say pre-series B, is that the company potentially gets pulled into the US by customer traction and user growth, right? And that's often backed up by the CEO or other people on the management team flying over on a regular basis to build up an awareness of the product or service offering. Maybe as an interim step, The company might hire contractors in the United States, which does not require a corporate structure set up, right? You can hire US-based contractors directly out of a UK or your European company. But then finally, after getting enough traction, let's say remotely from the US, that the company will then start to put people on the ground in the US. And as an aside, I think the most successful ones end up combining, let's say, homegrown American hires who have a contact book and an understanding of US go-to-market techniques, and people who have got the DNA of the business who move over. That blended, integrated team. And a quick aside, I think there's frankly a myth, right? That the money for that initial US expansion comes out of the United States. It's much more common for the money for that US expansion to come out of the UK or Europe, right? In other words, UK or European funds funding US expansion for a UK or European based company that's already gotten some initial traction and now needs more capital to really, put the pedal to the metal, as they say, and scale it up. And I sometimes get the question, why would a UK or European fund invest in a company, a UK or European company that's just going to go and expand to the US? And the reason is, well, why does a VC, invest in a company? To get the best possible upside. Well, if the company succeeds in the United States, its valuation is going to go up materially, which potentially leads to a maximum upside. That's why, right? But going in the middle creates a problem, right? And this is where we see too many companies not get it right, is that they start building up the business in the UK, and before they really nail it in the UK, they kind of take their eye off the ball, right? Like as you said, the US is a massive market, and it's a little bit of a bright, shiny object, that as you're scaling the business up, you're like, wow, but if I went after the US, like that would be great. Okay, fine. But if you're not going to go pot committed to the US and, really decide I'm going to leave the UK kind of as a back office and go focus, with all my resources on the US, if you try to build product market fit simultaneously on both sides of the Atlantic, that's just a recipe for failure.
This was exactly our experience, right? So, I mean, I remember getting, term sheets and offers from Sandhill Road firms, and the condition of the term sheet was you move here. And I remember being surprised by that, but they said, well, actually, we can't really help you at this stage, so you double down. And we elected not to do that, but then we were part of that second wave, right, which we proved the demand. We saw demand from the US, and by that stage, we built a team here, and then we kind of opened in Boston, and with your help. But for those in the second bucket, so thinking about our listeners who are maybe like the first lawyer into the organization, and they're kind of going, what can you actually do to prepare? And what are the pitfalls that they're going to encounter when you say, actually, yes, now is the time to go in that second wave?
I'm going to talk about this maybe from a lawyer's standpoint, as opposed to how the founders might think about it, but specifically from an in-house lawyer's standpoint. The first thing I'm going to flag is that, there's not really much, if any, need typically to create any kind of legal structure in the United States until you start hiring U.S. employees, right? That typically the bright red line of when you would create a subsidiary, and typically it's going to be a Delaware corporation, wholly owned subsidiary of the UK limited company, right? The bright red line of when you really need that is when you're hiring U.S. employees, because you don't want to hire those employees through a UK parent company for tax and liability reasons, right? Like you would end up potentially creating what's called a permanent establishment, right? A taxable presence of the UK company in the U.S. Look, there are other points where you may need to create a U.S. company. Like, for example, if you're selling into certain branches of the U.S. government, certainly if you're raising early stage money, like a seed or Series A, you may have to what's called flip into a Delaware parent company. If you want to, we can talk about that as a separate topic. Just because U.S. VCs tend to prefer, on balance, investing into Delaware corporations, but the later stage that you get, the less likely it is that will be required. But putting aside a few exceptions here and there, the most common point where you end up creating a company is when you're hiring U.S. employees. But you can sell remotely, right, without a U.S. company for a long time. And if you're thinking about expanding in that way, which is that you're offering the product or service to American companies or American users, I'm just going to flag there's kind of 5 main areas. Like, pre-US setup. And it's number one, business insurance, making sure that you've extended your business insurance to the United States because there's a different risk profile there because of the litigation environment. Number two is sales tax, right? Sales tax applies on a state by state and locality by locality basis, even if you're selling in remotely from the UK. So that is something to talk to your tax advisors about. Number three is IP protection. That patents and trademarks are country specific, generally speaking. So if you are going to be selling remotely into the U.S., you want to take a look at whether, if it's relevant, extending your IP protection to the U.S. Number four, data privacy. GDPR doesn't apply in the United States, and so you want to make sure that you're complying with U.S. data privacy rules. And number five is commercial contracts, right? Your T's and C's that. Obviously, some companies in the U.S. might insist on U.S. law, U.S. jurisdiction. And by the way, when I say U.S. law, I mean U.S. state law that you pick. It's one of the U.S. states and U.S. jurisdiction for disputes. But there's a second approach to this, which has nothing to do with the governing law, and that is that market norms in commercial contracts around things like indemnity and reps and warranties and limitation on liability and confidentiality and IP ownership and all of that are somewhat different in the United States, right? And regardless of whether you end up under English law or U.S. law, right, it will streamline the negotiations of your contracts if you modify them for U.S. norms.
And that last one, obviously, contract is very close to our hearts. But I remember it was super fascinating also, not only the content of that contract, but also kind of the style as an expected kind of norm, whereby kind of positioning yourself in that way is materially advantageous. And of course, by the time you have lots of US customers and sort of subsidiary, it's all kind of done by then. But I remember that being surprising and actually a huge value add.
And I think one of the things that companies find surprising when they come out of the UK and Europe and negotiate contracts with US companies is how much more aggressively and maybe persistent that American companies are in negotiating the specific terms and conditions and the specific contractual language. And the reason for that, right, is the difference in the litigation environment in the US is that because the US is not loser pays like it is in the UK. In fact, little bit of inside baseball knowledge here that in American law schools, the UK approach to legal fees in disputes is referred to as the English rule. It's actually taught in American law schools as the English rule, right? The American rule is that each party bears its own costs in litigation, typically, even if they win, which means is that it is possible to weaponize litigation claims in the US to push companies into a position where their choices are go to court and win, but now they're out $1 million, $2 million, whatever in legal fees that they don't get to recover, or they settle on the other company's terms. And so in that context, it's much more common to end up using the terms and conditions both as a sword or a shield, depending on what side you're on. So I remember a British tech CFO once said to me, he said, in 25 years of doing this, I've never had to take the contract out of the drawer after we signed it. And I said, yeah, it's usually a weekly undertaking in U.S. companies, right? Because it's a living document that you end up paying attention to because of that dynamic of, it's not that everybody sues each other all the time, but that the threat of lawsuit means something very different and is used in a very different way to reach very different outcomes than it is in the UK and Europe.
It's so interesting. I'd love to just go a bit deeper on the litigation environment specifically, because imagine you're a sort of Series B stage company. You've got 1, 2 lawyers maybe in the company, and you're expanding, and you kind of bought your insurance critically, and you've gone through these steps. What are kind of typical examples of ways you could be sued, or you could experience at least like the front end of that litigation?
Sure, and I'll give you some examples of that we've seen with startups, right? Because it's so. For example, the U.S. is termination or employment at will, right? When it comes to employment, it is actually relatively straightforward to terminate an employee in the U.S. for basically no reason. I mean, you could, as an American company, walk in and tell someone you're fired. And they have to literally like take their box of stuff and walk out the door, like you might have seen in the movies. But there's also a robust set of anti-discrimination rules in the U.S. and rules about complying with like payroll tax obligations, and rules around who does not constitute an employee. Like if you hire a contractor in the United States and you're not careful, they could unintentionally be deemed to be an employee, right? And all of those things can create exposure, right? Exposure for the company. And employees in the US, or I should say individuals in the US, are probably the savviest in the world, when it comes to knowing their legal rights. But what are you going to do? You're going to go to court and fight it out? Right? Because the problem is that that's expensive. Maybe you do fight it out. But what ultimately often ends up happening is that you work with your outside counsel to come up with a script of what you're going to say to the individual. You make sure to deliver that, usually with multiple people in the room, so there's no question as to what was said. And then finally, you'll enter into some sort of settlement arrangement where you provide severance, which is not otherwise typically required, in exchange for a release of all claims against the company.
And this can be existential, right? I mean, if you're sued for hundreds of thousands of dollars, you're at the seed stage, huge distraction value. I mean, it's critical to avoid those situations, right?
More often than not, it's usually straightforward to avoid it, but you have to be thinking ahead about it. It's just, you have to know what the market norms are in the US, which might be a little bit different than in the UK. Or for example, intellectual property. I'll go back to your original question. Can you give some examples of how this ends up playing out for companies going to the US? Let's say that you don't do a proper trademark search when you go to the US and you just start selling in the US. And there's a company that has a brand that, look, if you actually litigated it, would there be a, quote, likelihood of confusion, which is the trademark infringement standard? Maybe not, right? But the US company wants you out of their market. So what do? They send a threatening letter and say, you're infringing our mark and you better do something about it, or we're going to sue you. Well, now what are you going to do? I mean, are you going to go take on this company and fight out a trademark litigation, or are you just going to say, no, I'm going to go give up my brand and go start again? Like, and you don't want to be in that position. But again, there's a way around it, which is that you proactively do a trademark search in advance and you understand what the landscape looks like. And those two examples underscore a fundamental difference about legal in the United States than legal in the UK and Europe, is that it's much more on a proactive advice basis rather than a kind of reactive instruct basis. In fact, that language, instruct a lawyer, that phrase does not exist in American English, right? I had a partner of mine over here a couple months ago and was talking to a company. The company said, we're thinking about instructing you. This is a partner from Silicon Valley. And he responds, instruct us? I haven't been instructed since I got in trouble with my mother when I was 6 years old. I have no idea what you're talking about. It does not compute, right? And that reflects, the difference to some extent of how you end up engaging in the US, where, the legal advice that you're going to get in the US really centers around one question. And frankly, it's the same question that in-house lawyers in the UK answer for the companies that they're working with, which is, how does the company achieve its business goals while managing risk, right? Because if you just focus on risk in the United States, like, you're not going to get anywhere, right? Like, I'll give you an example. I went back, to New York, last year, and I went to my old gym, right? And I was going to go take a shower there after a workout, and they said, well, you need to sign a 3-page liability waiver. But that gives you an idea of the American thinking about risk. Like, you might slip and fall and sue us, and so we need a liability waiver. But on the other hand, if you don't pay enough attention to legal in the US, then you end up sort of getting run over by the litigation train, right? And so every business decision in the US has a legal component, and the legal advice always has to take into consideration the business realities, right? And that's sort of like, that is the overarching approach to law in the US.
I mean, there's so many learnings as well for in-house lawyers. I mean, there's always this kind of talk of how the general counsel is sort of less valued in continental Europe and the UK than it is in the US. And you run arguments, well, actually, litigation is more important, whatever. But actually, it's this point that you mentioned around really understanding the business risk and really understanding, what is the upside here. And it strikes me that actually it's quite instructive for a UK or European based GC to go to the US and to experience that culture and experience the centrality of the role. Actually feels like a kind of great opportunity if you're in those shoes.
No, I agree with that. I mean, the role of the lawyer in the U.S. is much more central to or not just say is central to building a business in the States. I mean, I'll give you a great example of this. If you're running a venture-backed startup, homegrown in the United States, it is generally expected that there is going to be a lawyer at the board meeting, either your outside corporate counsel, right? Or your general counsel, or both, right? That you might have, and just this is not just because there's a particular problem. This is standard operating procedure. At every regular board meeting, you are going to have your outside corporate counsel and or your in-house general counsel. Why? Because as I mentioned, every business decision has a legal component to it. So the lawyers have a role to play, right? In overall, thinking company strategy, right? And board decisions. And it's funny because the other day I was telling a UK VC investor this, and he said, that's really interesting. He said, and I'm not quite sure I believe this, that you're telling me this, Dan, right? But in the UK, of course, if we had the lawyers at the board meetings on a regular basis, that would be the sign of a dysfunctional board, right? And then, so I was in the Bay Area earlier. I guess it was a couple weeks ago, and I said this to a few VCs, and they said, "Are you kidding me? If the lawyers did not come to the board meetings, we would see that as a sign of a dysfunctional board." Like, that is a massive disconnect between how you govern, right, a company.
And it's so pivotal as well when you're expanding to the US. And if you go back to the size of that market for we're kind of AI software company, but whatever your company is, at the end of the day, if you see real traction, you will become as much a US company as a UK company, European company, and that kind of almost getting ahead of that cultural point as well as all of the operational things just seems really really important. And I can just sort of see how sticking in the kind of old ways of very UK centric could actually really hinder. I mean, your ability to hire great executives and your ability to go and fundraise and all of these things we've talked about. I just want to ask you, if I can, about just the latest developments on tariffs, because this has obviously come out in the last few days just before recording this. A lot of businesses asking, what should they be doing about this? Just kind of curious how you think about this from a US expansion perspective. Like, does this actually change anything in the way that companies should be thinking about going and expanding into the US or selling their services in?
Companies, I think, should be looking at what it is that they're actually selling, and whether it's going to be subject to tariffs. Right? I mean, if it's selling, if it's operating a SaaS company, right? If it's operating some sort of platform, if it's providing services, or those can be subject to tariffs. And if not, then this may not be applicable, right? If they're selling hard products, that I think that's a little bit clearer at this point. But if you're sort of like a venture-backed SaaS or software company or an e-commerce company, like, it's not necessarily clear yet, right, what the dynamic is going to be on tariffs. So I would, in that respect, take a little bit of wait and see approach. It ultimately goes into the pile of considerations of what I always tell companies here, which is, if the question is, should we go to the US? The answer really is, like, what is the likely ROI, right? Don't go to the US just because it's the US, right? Don't go to the US because it's the biggest commercial and capital market, but it doesn't necessarily mean automatically that your company is going to be well suited, right? Whether from a product market fit standpoint or frankly from a cultural standpoint. It's a little bit like the question I often hear, which is, does the founder need to move to the United States? Does the CEO need to move to the United States in order to build a US business? And the answer is, well, what does success look like for the company in the United States? If success is we need to become the market leader in our sector in the United States, then yeah, you probably do need to move the CEO to the United States. Why? Because you are not going to win an away match at the most competitive stadium in the world by leaving your best players back at home, right? But if the goal is thinking, hey, we are a global UK-based company, and we see the US as a nice revenue source of many revenue sources, well, why would you pick up the CEO and move them to the United States? That doesn't necessarily make sense. And by the way, the thinking on that may change over time, right? And I think, certainly as a startup or a scale up, you need to be flexible in that way, which is you may start off thinking that the US is a nice to have. You may end up finding that you get such amazing traction that it becomes the need to have, where the ultimate success or failure of the business is inextricably tied to succeeding in the US market, in which case, yeah, you got to put your best people on the ground more often than not.
Yeah, it's a really neat way of thinking about it on the ROI side, the kind of the cost and the benefit. And, the benefit, it strikes me, I mean, in our sector, right, sort of, AI native software, the market's very, very large. If you want to go very big, seems like a complete necessity. Maybe this changes over time. Maybe there are wedges you can find in Europe, but for us, it's kind of it's pivotal. But actually, the cost side was something as we expanded out into Boston, you start looking at really the brass tack stuff, like how much does a salesperson get paid, in New York, or in Boston or in California, and it's more, right? And so, you kind of balance that equation, see where we land. But I could totally see, companies, board meetings saying, go do US, no validated traction, send a couple of people out, hire some very expensive people, doesn't work out, negative ROI probably, right?
Yeah, no, absolutely. I mean, strangely enough, right, I mean, we regularly talk companies out of going to the United States. Right? Like, our role is not to cheerlead businesses that are not, that ultimately are not appropriately prepared, or ultimately whose goals are not aligned with what it takes to spend in terms of effort, money, and time to succeed in the US. We don't want those companies necessarily to go to the US without eyes wide open. And yeah, I mean, it's important to understand that, yes, it may cost you 500,000, 700,000 to hire your head of sales in New York or Boston. But if you've got product market fit and you've got a big enough TAM, total addressable market, that head of sales will make 10 times or more what that salary is, and you will, on balance, make a lot more money. But if that approach ultimately is just culturally awkward for the business, then don't do it.
And I do keep coming back to your point on product market fit, right? Which is, you do get some signal of this within the company, right? So if you have, for example, a high level of inbound leads coming from the US, or you have customers saying, we have a subsidiary in the US, could you work for them? These are sort of telling you as a founder as well that actually there's market demand for your product. And it may just be a few leading indicators, but it's something. And we've definitely seen lots of cases where, certainly being pulled by seed stage VCs or whatever it was, it's kind of, just go there theoretically, it's going to be great. But based on what you're saying, it's high risk, high reward. And I think this is a really interesting way of thinking about things. Just before we wrap down, I'd just love to get from you top 3 tips here. So we've covered a lot of ground. We've covered culture between the two countries. We've covered fundraising, how to avoid some pitfalls. But, what are the kind of top 3 things that you should be thinking about, let's say, as a new GC in a fast growth tech company thinking about doing this?
Okay, so the first thing that I always say about expanding to the US is go with intentionality, right? Go knowing what success looks like, and then figure out the approach from there, right? What are you trying to accomplish in the United States? And then figure out what it is that you need to do to achieve that kind of success. Second thing that I would say is, and I don't think enough companies do this, go and meet companies that are native, homegrown, American venture-backed businesses. And if they don't know anything about the UK and Europe, the better, right? And do a gap analysis. Final tip is, don't assume that the US is the right place, right? What I mean by that is, do your diligence, and if it doesn't make sense, it doesn't make sense. However, if it does, then you are going to need to pivot into being a lot more aggressive, spending a lot more money, and running a business in a very different way than you may have done it before in the UK and Europe.
Dan, this has been a hugely insightful conversation. I know lots of our listeners are in legal teams thinking about this right now. So we really appreciate you taking the time today. If people want to connect with you or follow more about your work, where should they go?
I am on LinkedIn regularly, hopefully with useful content for those who see me on LinkedIn. So you can always reach out to me on LinkedIn, and all my content information is on the Wilson Sonsini website, wsgr.com.
Awesome. And I can highly recommend working with Wilson Sonsini, as we've done for quite some time. Finally, we will be hosting together a joint event, which is Scale Up GC, which is going to be on the 11th of June. It's going to be in London. So if you're based somewhere nearby or would like to fly in for it, we would love to have you there. And hopefully we can talk more about this topic and many other things on that date. Thank you so much for listening.